Good morning, everybody. Hopefully you can hear me. There is a chat on the right-hand side. If you want to just pop in the chat whether you can hear me okay. Good morning. Awesome. Got a few people popping in there. Cool. We might just wait another minute or so. Apologies for the issue on the website this morning. It is definitely 10 a.m. I wasn't planning on being here still at 10 p.m. tonight. Yeah, like I said, I'll just give everyone another minute or so to join and then we will get started. All right, we might kick off. It's a little bit strange doing a webinar like this and not being able to see all of your faces like we usually can on the Zoom meetings. So I'll just be listening to myself talk. Good morning, everybody. Thank you for joining us for today's webinar. We are recording this session and we will be sending out a link to all members in the next few days. So if you do miss any part of it, you will be able to rewatch that. My name's Summer. I'm the Projects and Events Manager for MPAQ, and today I'll just be moderating the session. It's great to see so many of you registered for today's, and today we will be chatting about charge-out rates with Suzanne from Xact Accounting. So together with Xact, MPAQ recently relaunched our guide to calculating charge-out rates and the accompanying calculator. So today Suzanne will be taking us through that and showing us some real-world examples of how these tools can assist your business. If you do have any questions throughout the session, just pop them into the chat. We'll come back at the end and we'll allocate some time to a Q&A. So we will definitely get to all the questions that come through today. But Suzanne, thank you for joining us.
Thank you, Summer. It's lovely to be here.
I might hand over to you. Thanks a lot.
Thank you. And thank you, everyone, for joining today. It's great to have so many on the call. Thank you, Summer, as I said, for welcoming me so warmly into the session today. So we're going to kick off and have a bit of a chat through charging, as that's what you're all here for. So we won't hold you up too much longer. As Summer said, if you do have questions as we go, please pop them in the chat and we will have an allocated time towards the end to run through any questions as they come up. So the charge out rates guide has just been reissued. This is something that we put together initially with Master Plumbers about 3 years ago. And as we all know, a fair bit's happened over that time. So we thought it was time for a bit of a refresh. I have got some links later in the presentation where you can download the guide and the calculator, which I'll talk you through extensively today as well. A little bit about us. Xact Accounting is Queensland's leading building and construction accounting firm, and we specialise in QBCC licensing. We obviously work very closely with Master Plumbers and are tax experts as well in this space. So if you do have any queries as we go through the presentation today, please feel free to reach out and we'll address them down the track. So we'll get started. I'm going to go through, as I said, the guide itself in a little bit of detail, but first I want to kick through a few reasons why we need to actually review pricing. And as you would all have experienced over the last 12 to 18 months, it has been a pretty rough ride and material prices have been increasing fairly significantly. We're hearing across the industry in plumbing and other sectors as well, in that materials have had some quite hefty price increases. Labour prices will be increasing. If you haven't felt any wage pressure yet, it's definitely coming. Inflation is running at 5.1%. We've all heard about that recently. Minimum wage has just been increased by that at 5.1% as well. Interest rates are rising, and fuel prices, of course, are going up as well. So all of these things are impacting significantly on our business costs and operational aspects of the business. As a result, we do need to be referring to our pricing and reviewing it on a regular basis. So the question is, how regularly should we be reviewing these things? And at the moment, I've got some clients that are reviewing quarterly, given the frequency in which prices are increasing. But at the very least, I think you should be reviewing at least annually at this point. And as I said, some people are doing it a little bit more quickly at the moment with all the changes that are coming through and the impact of other pricing across the industry. So let's move forward. I just wanted to talk you through a quick case study. We've got quite a few clients that when they first come to us often don't know whether their pricing is correct, don't know whether they're charging what they need to. All they know is that they tend to not have a lot of money in the bank and can't understand why. Feel like they've got a lot of work on, that the boys are always busy, but they're not really getting the profit that they want, and the money in the bank is not reflecting that. So reviewing your pricing is one significant way that you can make that happen. And a couple of times we've had clients come to us with exactly those situations, and after going through pricing, reviewing pricing, and we're not suggesting big increases straight up, we're sort of talk to them about incremental increases to try and bring you up to where market might be, and now making some reasonable profits. One client of mine came in with a turnover of around 850,000. Next to no profits. Pricing increases and just tweaking some of those things a little bit is now making a 20% profit on that money. So, which is fantastic. And what we're all after and what we're all chasing is that profit at the bottom and at the end of the day. So one of the biggest challenges business owners face is negotiating with ourselves. And I think this is one of the biggest issues that we have with pricing. And when we start talking to business owners about pricing, is that argument that we have with ourselves. My customers won't accept the increase. I don't know how to talk to them about the increase. I'm happy with what I'm charging, et cetera, et cetera. And we tend to talk ourselves out of it. Most of the time, though, what we find when we work with clients is that there is no need for concern in this space. Clients and customers are quite willing to look at what you're offering and see value in the services you're providing. So there's usually no pushback when it comes to pricing. But we have got some tools later in the session today that can help you in that space as well. At the moment, I guess as well, it's in terms of pricing, it is almost expected. Everyone's prices are going up. Sorry, Reserve Bank. So we should also be looking to make decent margins. And if that means reviewing our pricing and rising that in the current market as well, then that's what we should be doing. So keeping those things in mind, it is critical to work out how do we do it. And what are the things we need to be looking at when we are working out what our pricing needs to be? So the first thing I want to talk you through is markup versus margin. And there is quite a difference between what markup and margin is, although having said that, they rely on the same data. So I'm going to go through a couple of quick examples with you now, just to understand the difference between a markup and a margin. And this is where a lot of people get quite confused. So my first example here is if you buy an item for $100 and we add 50% onto that. So we're adding $50 to give our sale price of $150. That's called markup. So that's where we're marking up the cost of our item to get our sales price. The inverse of that is where we actually sell it for $150. It cost us $100. The actual margin is $50 that we worked out before, which is what we applied as our markup. But that actually conversely relates to a margin of 33.3%. So although our markup is 50%, our margin is only 33.3%. So it's important to understand there's a difference between these two. Second example that we're using here, same item costs $100. We want to add our markup of 100%, which will give us a sale price of $200. So conversely, in that example, our sale price of $200 means our margin is $100 or 50%. So our markup is 100%. But our margin is only 50%. So it's critical to get those in line. And when we go through and we have a look at our example later and we start working through our calculator in more detail. So I just wanted to talk through as well a couple of other fundamentals that we need to consider is regional pricing. And we know typically regional areas have quite different pricing to city-based areas. And interestingly, while we know that our inflation is running at 5.1% in Brisbane or across Australia, our actual regional inflationary rates are sitting a bit higher than that, around 5.3%. But it's interesting to note that our actual rates that are being charged in regional areas sit roughly about 28% below city-based areas. So it might be critical if you are in one of those regional areas to really have a think about what your pricing levels are and whether they do need to be reviewed and increased. And of course, the other thing we've got to keep in mind is competitiveness. So we can't be just hiking prices for the sake of hiking prices. We need to make sure we're staying competitive across the industry as well. So question is, when did you last do a review of your pricing? And have you looked at both labour and materials when you're doing that? Because typically what we find is clients are quite aware and very across material increases and increasing on the materials and consumables that they're using in the business, but not always clear on how to calculate labour pricing correctly. So we're going to talk about both of those today and work through some examples for you. The guide itself, if you've got a copy of that, this is the example that's published in the guide. And I'm going to go through, I won't go through this one in too much detail because we want to go through some actual examples, live examples in a moment. But what we're looking at here, and this is just to give you an idea of the basis of how we calculate labour particularly. So we want to look at how many days available do we have in a year. So if we've got 52 weeks in a year and 5 days of that is our working week, it gives us 260 days a year that we have available for work. Now, across those 260 days, we've got 40 hours in a week. However, that 40 hours in a week is not always spent on chargeable jobs or out on job sites. So we've got to factor in how much per day is actually available for chargeable work. And in this case, this example, we've used 6.5 hours. So we then have to factor in other leave days, so holidays, statutory leave, public holidays, sick days as well. If you provide RDOs, roster days off, we've got to factor those in. So these ones we're looking at here is how many days per year do we need to take out that are not available to work because of leave or other things. Other days that we should be considering, training days. So particularly where you've got apprentices working, it's important and critical to make sure you factor in their training days. Rain and bad weather days, it's already been a fairly wet year, and I'm sure you guys have lost a fair bit of time to rain and wet weather. I was just reading this morning that there's expected additional wet weather coming for the rest of the year, and they don't expect it to ease up until even closer to Christmas. So keeping that in mind means we probably need to factor in slightly higher rain and bad weather days than what we would have in other years. And traditionally, we've said about five or so days in this example, but you might need to think about that and say, well, in my business, in my case, how many days are we losing this year because of that? Quiet trading days is another one to factor in. So thinking about other guys on the tools, are they busy all the time, or do you have some quiet days where they might be catching up on other bits and pieces, restocking or doing some admin type work, or you just haven't got enough work floating around to keep them busy on those days? So factoring in some of that time as well. So once you've worked out how many days in the year are lost in terms of leave or other factors, you then need to look at what the total chargeable days or days available to work actually is. So taking our 260 from the top, taking out our 67 days unavailable, we've now come down to 193 days is actual time that we can work. So on that basis, we look at our 193 days multiplied by our 6.5 hours per day that we said were available to do client work, gives us 1,255 hours available then for work during the year. Now, that's critical in the next step. So when we come into the next step, and I'll show you how to work out all these figures in a moment, but we've estimated here tradesperson wages of about 78,000. We've factored in super there at 10.5%. It did go up on 1 July. So if you're not across that, you need to be across that. And then we've also factored in work cover in there as well. So our actual costs for this employee is 87,500, not the base 78 that we'd often work with. So once we've worked out the base wages that we're working with there, take into account our actual chargeable hours, so 87.5 divided by the 1,255 hours we had on the previous slide, gives us a charge rate or raw cost for this employee of $69.77. Now, then we've got to factor in what margin do we want to make on this work or on this particular employee. And in this case, we've used the example of 50%, giving us a charge out rate for this particular employee of $139.54 per hour. So this is why it becomes quite critical to work out days available and the actual cost for your each employee, so you can work out exactly where their charge rate needs to sit. And a calculator that we've got available, which I'll talk through in a moment, it goes through and it's got availability for you to put in all your employees side by side. So you can see exactly what costs are for each employee, and at the bottom, what the actual charge rate should be for each of those employees as well. So we'll go through some live examples in a moment. I just want to talk through materials quickly as well. Now, most of you will be across this, but it's important to note when you're working out what markup you should be applying on your materials to factor in things like what's not charged. So you might have wastage. You might have bought a length of pipe. You're going to have little wastage bits that come off the back of that. You might have a sample stock as well that you might be supplying or that you have in that you hold in stock that's never actually on sold to a customer. So we've in this example allowed for 5% as material that's not actually charged. We've then said our desired profit margin is 15%. And then we've also looked at what our overheads are as a percentage of turnover. And this is to actually factor in our percentage of overhead into our materials cost to try and cover some of those overhead costs as part of our recoupment on sales of materials and other consumables. And I will go through in a moment an example, and again, our calculator covers this, how to work out what your overheads are as a percentage of turnover. So what that means is rather than just saying, well, I want a 15% desired profit margin, we actually need to add all these three percentages together and say, well, actually our desired margin is closer to 45% to cover off on those other factors. Now, talking before, we went through our margin versus markup. So our desired margin of 45% actually means a markup of 81.82%. So that $100 item that we had before actually needs to be priced at $181. In this case, the example we've used is a $150 item. Multiply that by our 81.82% markup, gives us our $272.70 as our sale price for that particular item. So as you can see, there's a fair bit to look through and to work out how to actually get to those bottom numbers. And as I said, we're going to go through some live examples in a moment to talk through exactly how to use the calculator. If you don't yet have a copy of the guide or the calculator, that QR code there is live, so you can scan that from the screen and be able to download that. If you haven't already done that, it might be worth doing that because when we move on to the next couple of slides, we're going to go through some live examples. So let's do that, in fact, jump across and we'll go to our calculator. So give me a moment while I just switch the screen across. Okay. So this is the calculator that we'll be downloading. And if you haven't, as I said, you can download it from that link there. And the link will be available once we send out the webinar as well. Now, I'm going to start firstly with the employee costs calculator, which is tab 2. So you'll see there's a few different tabs here at the bottom. You've got your break even, employee costs, business expenses, and material markup. So we'll start with the employee costs. The blue boxes are the ones that you can input into. The yellow boxes are auto-calculating fields, so you don't need to worry about those. Now, to make it easier, you can add the names of your employees into those columns. You can also add their classifications in there. So we've got a few examples in this case, just a standard employee. We've put a subcontractor in there, a casual worker, and a couple of apprentices with some different rates. So the hourly rates, it's important to get those right. So if you're what you pay your employee is the rate that you're putting in there. So that's some examples that we've put in. So 55 for the employee, and we'll work through in a moment. Make a note of whether super applies or doesn't apply. Now, in some cases, depending on the nature of your contractor's relationship, you may be liable for super and work cover on a subby. But if not, just leave those as no. Your casual workers generally not. Will have super and work cover, but your other employees definitely will. Now, as I said before, we've also factored in our holiday days. Again, subbies and casuals don't tend to provide for holiday days, and sick days as well we've factored in as the normal statutory rates, again with public holidays. Now, if your apprentices are only part-time, you would need to factor in those days as well in relation to what their part-time hours are and what the actual days are that they'll be unavailable for those different events. TAFE and training days, again, we've put some higher rates in there or higher number of days in for apprentices. But generally, we'd say you need to allow for some CPD training, some other training days and things for regular employees. Subbies tend to look after themselves, and casuals depends on you as to whether you are going to allow them time or not for those. Wet weather days, as I said, we might need to be increasing that this year. So whatever you think you need to factor in there, it's just a matter of putting those days in. Standard days, weeks in a year, 52. Standard hours in a week. Now, some people will use a 38-hour week, which is the award. Others will work on a 40-hour week, sorry. And our average daily hours then is 7.6 if it's a 38-hour week. So just dividing 38 by 5. We're allowing for an hour lost per day. Now, that could be an hour of travel. It could be an hour of admin time. It could be just an hour of dropping by to pick up some other bits and pieces that they need for a job. So that might be higher or lower for you, depending on what you actually need. And the other thing I should note is if you've got other factors in here, maybe you provide for birthday leave, maybe you give your employees a couple of extra days off for other things, I don't know, charity work or different things like that. So you could add an extra couple of days in there if you need to. Some people like to give extra holidays as well, rather than the standard 4 weeks, you might be offering 5. So it's important to update the number of days in here to match what you need for your specific circumstances. Now, and again, those hours lost each day as well, you'll need to revise based on your personal circumstances and how it works in your business. These yellow boxes are auto-calculating. Super, as I said, 10.5% from 1 July. Work cover we've put in at the 1.2. Again, if you're on a higher rate for whatever reason, you'd need to just maybe update that a little bit there. So once you've got all of that set, you're happy with your hourly rates, you're happy with the days that you are not available to work and the days available, or sorry, hours available to work in a day, we can then jump down and have a look at what that does with our calculations at the bottom. So we've worked out then at $55 per hour, our employee's annual rate is $108,680. We've put in our super at 10.5. We've put in our work cover, which gives us a raw cost for this employee of $121,500 per year. And then we've worked out, based on the number of hours available for this particular employee to work, that their cost to us is $62 per hour. If we pop on down here, so work days in the year, that's based on the calculations above as well. Work hours, the same as what we calculated before, so that's based on the adjustments we've made, gives us networking days of 140 in a year and networking hours for the year of 1,064. So actual work hours, adjusting for this job efficiency, which is that up here where we've put in our 1 hour per day that they're not able to work, gives us 87% efficiency. And adjusting for that down here gives us 924 hours available for the year. So what our real cost is, so when we work that back based on the actual 924 hours available rather than the total that we would normally have, where actually our cost on this employee is $132. And it can be quite surprising when you go through these numbers and actually look at what an employee's rate is actually costing you per hour compared with what you're actually paying them per hour. So your cost to the business is quite a bit higher than that. So as we come on down, the next part we want to look at is what is our desired margin or markup for this employee. So we're saying desired tends to be around 40% as industry standard. So we've put our 40 in there. If you're aiming for 50, it will automatically readjust at the bottom. If you're happy to take a lower rate, again, it will adjust at the bottom. The markup will automatically calculate based on what you've put in there as your desired margin. And as you see, if we put in the standard industry of 40%, our actual charge rate we should be charging employee number 1 out at is $219 per hour. And you can see as we made those adjustments before, all rates at the bottom are changing on that basis. So that's working through how you would do that for your employees. And then you would go through for each of your employees and do the same thing again, factoring in each particular personal circumstances for those employees and your business. And then at the end of the day, you're going to pop out what those charge rates should be per employee. Now, some people think it's a little bit complex to go through and do every single one, particularly if you're running a larger number of employees. If you've got large numbers in there, you might want to group them instead. So you might say, well, I've got my senior plumbers and I've got my apprentice, and we'll just work on the basis that we're going to use similar rates for all of them. So you might come back and look at average wages or average hours, or et cetera, to work those things out. But the simplest and easiest way to get an accurate picture is employee by employee. So I hope that helps in understanding how to work through the employee costs. We'll now have a quick look and go through the overhead side of things. And again, same rules apply. Blue is the ones that you can type in, yellow are auto calculating. Now, I've used an example here of a business turning over about $850. Now, if your business is more or less, you'll need to put in your own turnover in that space. And then it's a matter of just working through what your average costs are per year for all of these different items, which tend to be your fixed costs. Now, I know fuel changes all the time, but roughly speaking for you, you're looking at probably 10 to 15,000 per year for fuel. Yours might be more or less, again, depending on what you've got there. If you're running 2 vehicles or 3 vehicles, it might be a bit higher again. So just working out what you've actually got in terms of your costs there. Parking and tolls, advertising, etc. Just working through, putting all those costs in, rent and all those sorts of things. There is a office in there somewhere. If you can't find a category that fits what you're after, group it with something else, or just call something general expenses. It's not a big deal for this exercise. What we're trying to work out at the end of the day is what roughly your total fixed costs are. And then at the bottom, generating that percentage that we were talking about before. So that percentage there is telling us that our 88,000 of costs divided by our turnover is about 10%. So our overhead costs are sitting at about 10% of our revenue. And then we flick across to our materials, and that 10% is included when we look at our desired margin. So we're saying here our cost for the item, and again, that's what you would put in there. Cost is $100, or maybe it's 80, maybe it's 250, whatever it is. Pop that number in there. Looking again at industry benchmark, a lot of people are saying it's average 40%. I know some people that can, getting away with smaller items, washers and different things like that, at maybe even a 200% markup or margin, and others, on bigger items like a hot water system, you're not going to get away with that. So that might be closer to a 10 or 15%. So you're looking at what's the actual cost to you of the item. Say it's $850 and we only want 10% in there. Well, your charge out on that is going to be a lot lower than it would be if you're running a $15 item at, say, a 250% markup. So you've just got to work out what the actual rate is for each item that you're looking at and just plug those numbers in. Your materials not charged. When we talked about that before, remember that's things like wastage, or if it's a sample that you're keeping in stock just to show people, factoring that in. We find most clients are looking at about that as 5%, but your business might be higher or lower than that. You might want to pull it out entirely, or you might want to put it in only at 3%, whatever you think that's reasonable to be. And then again, these percentages and calculations under here will work through by themselves. So all you've got to worry about is the cost, what your desired margin is, and what your materials not charged amount is, and then it will drop out that price for you at the bottom. Now, the final piece that we've got in the calculator is a break-even calculator. And this is quite helpful just in terms of knowing what you need to be doing in terms of number of jobs per day to be able to cover all the costs of your business. So again, we've used the 850,000 turnover as an example. We've said that our cost of goods sold in this case is 510. So that's our labor costs and other variable costs that go into generating that revenue. And that's giving us a gross margin of 40%. And that's what we think is typical for most businesses in the plumbing space. So that's giving us gross income of 340. Now, we've then, as we worked out before, under our business expenses column, we've worked out our fixed costs of 88.5. We've put that number in there. So that's our yearly fixed costs. This table here is then breaking that down into our monthly, weekly, and daily fixed cost amounts. And we've said that that works out at about 10% of revenue, which it does. Our gross margin in this case, again, is around 40%, pulling across from here, which means we need to get, for break even, just to cover those costs, we need to generate $220,000 of revenue. And daily means $600 of revenue. Now, if we scroll down a little bit, this is where it becomes quite interesting. If we set our average sale, dollar value of sale is $500. So that's your call out fee and your average in terms of the amount of work you do at each job that you're generating. If you said that that average is 500, it means that you need to generate one job per day to be able to cover your break-even costs or get close to break-even. And if your conversion rate is 60%, so that's how many leads you've got coming into the business and how many of them turn into business, is 60%. You need to be generating 2 leads per day to be able to generate that 1 sale per day to cover your costs and get you at break-even. Now, break-even is not ideal. So what you're looking at, obviously, is a higher rate than that. But that's basically what we're looking at in this sheet, is to work out what break-even is. So you can work out what your minimum targets are to cover those costs. So that's walking through the calculator. I'm going to jump back across now to our slides. Summer, if you're still there, can you flick across to the slides for me, please? Thank you. So for those that haven't downloaded the calculator, that QR code there is ready for you to go, and you can just jump in there and download that material. If you've got questions on that at all, you're welcome to have a chat with us after, or just pop some questions in chat at the moment, and we can come back to you shortly. We've also got a templated letter now. So remember at the start when I was talking about how we often are our own worst enemy and we will talk ourselves out of doing our price increases. This templated letter is a great example of how you can approach this with customers and the type of wording you can use, the type of the way that you can explain it to a customer so it makes sense to them. So if you're looking for a templated letter, again, that QR code will get you access straight to that letter. This is also available from Master Plumbers, so please reach out to Summer and she'll be able to send that through if you need a copy and you are unable to download it at the moment. And finally, we've also got 7 signs of a difficult customer as available for a resource for you as well. And that QR code will link you through to this one. And this is a document that will help you work through how to handle those difficult conversations with customers or other ways that you can approach things where you are struggling to have those conversations to bring up those pricings or to have those difficult conversations basically with your customers. So again, available from Master Plumbers. Contact Summer if you need to, if you can't access that, or download it with that link there. And that will get you that. If you are interested in getting in touch with us to walk through anything we've talked about today, that QR code is a link straight through to dropping in your details. We are offering a free consultation to anybody that would like to talk through this further with us. So log in there and pop your information in and we'll get in touch with you to follow you up and walk through any of the questions that you might have following today if it's not addressed elsewhere. Otherwise, that's fairly much my content for today. If anyone's got any questions at all, pop them in the chat and we'll be happy to address those.
Thanks, Suzanne. That was enlightening. We have had one question come through so far, and I've got some of my own as well.
Great.
So the first one is from Julie. She said, when you're calculating the costs, do you also do it for admin staff?
Great question. What we normally do with admin staff is include them as an overhead wage because we're not usually charging them out to customers. So they would be included as part of those overhead costs that we talked through before and factored in terms of your upsell or increase or your margin on your material pricing to help cover those admin costs.
Cool. And I suppose one that I had was around like the apprentices. Obviously in that calculator, we do have the column for apprentices and things like that. But I suppose how do you, when you're speaking to a customer and that kind of thing, they see that sometimes they'll go, why am I paying for that? You know, that kind of thing. How do you justify the apprentice charge out rates, or do you just do like one overall charge out rate for the jobs where you combine the tradesperson and the apprentice?
Yeah, really good question, Summer. So we've seen it done a couple of different ways. The combined rate is often a good one that people will look at. So once you've worked through the calculator and you've got your individual rates for each employee, then often people will look at that and go, well, what's my average? and work that as the actual rate that they're then charging. So it doesn't matter then if they're a senior or a junior apprentice or wherever they fit, they're using that average rate as the one that they will then go and charge to the customer. So it's easier. That conversation is much easier with the customer. You're not having that, well, why are you charging them out at $300 and that one's only, $150 and blah, blah, blah. You're using an average rate, which makes it a lot more simple for people to understand, and also a bit easier for you as well to convey that to them. And I have seen it the other way where they have used different rates. Usually I see that in cases where it's a more complex job or perhaps a much bigger job where you've got a couple of people responsible for different aspects on that, and they can get away with applying different rates in those instances where you might have a supervisor rate versus an apprentice rate. And you might look at that then based on number of hours that you spend on the client's job rather than it just being my call out fee plus, a couple of hours of labour. Which is a much smaller job. And so most people will use that average rate for the smaller ones, but in the more complex matters, will often use those separate rates in that space.
Yeah, cool. Does anyone else have any other questions? I haven't seen any others come through just yet.
Yeah, well, as we said before, if anyone does have any questions or if they've got specific issues that are, unique to their business, they're more than happy to either reach out to us or to Summer, and she can get you in touch with us to help address any of those queries. Or if you'd like a specific, 10 or 15 minute walkthrough on your rates with the calculator or check to make sure you're doing it correctly, we're happy to help there as well. So more than, happy to take any queries there.
Yeah, cool. And we may have just had a question come through. Yep, sorry, from Emma. So a lot of members in rural areas find it difficult to increase rates due to a lot of complaints from customers. Do you increase slowly instead of jumping up, say $20, $30 an hour?
Yeah, that I would definitely do it slowly. So you might be looking at just a small increment every 3 months or so until you can get it to where you need it to go. But it depends on where you're at right now versus where you want it to be and how far until you want to get there. So if you're saying, oh, look, it's a $30 or $40 an hour increase, it's much more palatable for your customers to do that quarterly as a $10 incremental increase than it is to hit them with $40 right now. So it might be a 12-month process that it gets you from where you are to where you want to be. So, yeah, but great question.
Cool. And we have had another one come through from Don. So this one's talking about call-out fees and how to calculate the correct call-out fee. So obviously we've been talking about like the service fee or the charge-out rate.
Yeah.
But yeah, is there a way that people should be calculating a call-out fee, or is that just purely business-based?
Often it's business-based. What some businesses do will look at their actual charge rates that they've got per employee and take that average rate as potentially a charge rate, a call-out fee. Others will look at it based on, well, roughly how much time does it take to get to the average work site, and look at what my vehicle costs are in relation to that plus a bit of time. So it depends on which way you want to do it. Some businesses keep it simple and just say my average hourly rate is my call-out fee, and then I just add my hourly rate on top for all the time I spend out there. So on average, it's probably not going to be much more than about an hour for you to drive out and back to do a call out anyway. So some people would just take that average hourly rate as their call out fee. Others want to be a bit more scientific and work it through in terms of time and vehicle costs and so forth to get to what that call out fee should be.
Yeah, cool. Chelsea did ask whether she'd be able to rewatch the webinar. So yes, Chelsea, we will send out a recording. And Emma asked as well, is it easier to do increased rates with new customers versus existing customers?
Often, yes. So new customers are less sensitive to what your existing pricing is. So it's often easier to give them what the new rate is. Whereas existing customers, if they value you in the service, they tend to not be too concerned if it's a smaller increase. But if it's a large jump, that's where you'll probably get some pushback with existing customers.
Cool. That looks like most of what's come through now. Thank you, everyone, for putting your questions up there. If you do think of any others, like Sue said, there was the link there to chat with Xact directly. Otherwise, yeah, we will be sending out an email with all of the resources that Suzanne mentioned, and also the recording from today as well. So you'll be able to rewatch that in your own time as well, and send us through any questions that you have. I did also just want to mention really quickly, MPAQ is currently has a survey open for our industry benchmarking report. So last year we did the first plumbing and gas industry benchmarking report. And this year we're doing an updated one. So this is all around the charge out rates and all that kind of thing, and finding out what the industry averages are, also with materials and supplies and all that kind of thing as well. So I'll put a link for that in the email as well. We obviously want to get as many responses as we can. It is anonymous, so you don't have to put in your own details if you don't want to, but just helps us with putting together an overall industry report that we can send out to members and to non-members to talk about what the current industry average is for charge out rates and those kinds of things. So please make sure you do that. But yeah, that's about it, I think, for today. So thank you again, Suzanne, for joining us. Thank you to the whole... Yeah.
Yeah, it's been a pleasure. Thank you.
All right. And thank you, to the whole team at Xact Accounting for the work that you guys have done on the guide and the charge out calculator, and on refreshing that with us. So yeah, everyone else, I hope you enjoy the rest of your day, and we will hopefully see you again soon. Thanks.
Thank you.